Cutler YMX uses the Netrodyne two-way camera system in all of our power units. The Netrodyne cameras have more than once exonerated a driver who was perceived to be at fault, as well as saved our Cutler YMX from paying damages related to an accident. We are already seeing, just in 1 year of Netrodyne, the impact of better safety scores and fewer damages and incidents in our insurance rates.
October 24th, Freightonomics. Zach Strickland, head of market intelligence, Tony Mulvey, senior analyst, here to talk about the freight market and the macroeconomic environment, and two of the largest transportation service providers in the country just had their earnings.
Which is what we've been, I don't want to say waiting on, but I think it gives us the insight to either confirm some of our thoughts or maybe change them slightly. I don't really think changing them. I think they've confirmed more than they've adjusted them.
It's one of those things where we've been talking about the market turning, and we're talking about the market turning in terms of transportation, prices, service. It's been extraordinarily depressed. In terms of a rate environment over the last bit. A lot of carriers and brokerages are, of course, talking about how they cannot get enough business to sustain them profitably. And then on the other side, you can, as a transportation manager or somebody who's procuring transportation, not a lot of problems outside of that pesky little international segment. That still seems to be, but I think we are seeing that market start to settle a little bit. I don't know if I would say that it's coming back.
The international side's one of the more interesting ones, just because of if you start looking at everything, it clearly the data suggests that we're past the peak. I don't think, I'm not going to dispute that in any way. I think what's going to be interesting is, call it the next 6 weeks.
I mean, we got an election coming up. We got rate cuts potentially coming up.
I mean, there's some potential for some, a boost in volume in a period that normally is kind of a lull. But I think you start looking at some of the international data, and it suggests peaks past on that front, and
but they're still bringing freight in. There's still plenty of freight year over year. We'll talk about that here in a minute. Well, why don't we thank our sponsor, Tony?
So remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% cut to your accident rate.
And also, it will help you in terms of driver retention. If you believe there is a driver shortage, please come to F3, where you'll get to hear John Larkin debate with Ryder on whether or not there is a driver shortage.
Absolutely. So, Zach, I think where we need to start with, though, is with the market in two, kind of set the stage of where we're at. So if you're ready, count you in 3, 2, 1.
All right, let's lead off with our tender rejection index, the percentage of loads being rejected by carriers to their contracted accounts. Still hovering a little above this 5% mark overall. We can see the ILA strike, the hurricanes gave the market a little bit of a boost. Certainly not anything that we would consider tight, but the fact that we're hovering here, something to watch. It's October. Normally we see rejection rates come down or at least stabilize and flatline until the end of the month. That is not happening. We're just kind of slowly coming down off of this little top. Again, should not be a huge issue outside of a few spotty little disruptive areas in the United States, largely in the Southeast. So let's move on to the next chart, the NTI versus the VOTRI. So spot rates finally, that's the white line you're looking at, spot rates including fuel, the National Truckload Index, starting to percolate here after the tender rejection rates. Now, that is the dry van tender rejection rate you're looking at, which is what we're largely measuring. The OTRI you saw before is both dry van, refrigerated, also flatbed, a little bit of intermodal in there as well. But the dry van sector has had its peak moment. And spot rates for dry van loads now starting to feel that pressure. We typically see this a lot of times where we see rejection rates lead the spot market. This could just be something that is, hey, it's news to us. Let's raise rates because capacity is not around. Rejection rates, of course, a great leading indicator there. I haven't seen it lead this strongly in a while, however. Let's go to the last but not least chart here, OTVI versus O-Rail. The outbound tender volume index measuring truckload tenders from shipper to carrier and the loaded container volumes moving on the rail. The rail is still absorbing a ton of freight. If you look at the yellow line there, that looks like it is really still absorbing a lot of that market share value, long haul freight primarily. So this is also a huge mechanism keeping the market relatively loose.
Yeah, absolutely. I think it can't be overstated, understated. I always get confused on which one to use, but I think the demand side, when you look at the slack that intermodal is basically taken out of the market, right? Like it's been the relief valve, largely speaking. And what's interesting is you had another chart that we didn't get to, but it's looking at it intermodal in the two distinct markets.
We can pull it up now.
Yeah, looking at the international versus domestic, and really the growth engine's been the international side. But I think what you're seeing is the domestic side is starting to wake up. And that's where to me, that's the truckload versus intermodal.
Yep.
It comes in the domestic side, and seeing that start to wake up. I mean, you said it, October 24th. You've got, call it 3 weeks before you really ramp anything up into Black Friday. I mean, you're getting close to what you would think is kind of the end of the intermodal. Yeah. Maybe a week or two left, and then you see truckloads start to pick up. You just really haven't seen it. Any signs? I think you've seen some. When I look at the OTVI, kind of where it is, you've seen a little bit of a slowdown in, the shorter lengths of haul. You've actually seen long haul demand actually pick up, which is a positive sign. We've been waiting for that. So, I mean, overall, you're seeing the signs of seasonality. We kind of talked about it last week, the return to seasonality. You're starting to see.
But I think the growth line here, something to note is that this volume's on par with COVID. This is what broke all the infrastructure from the intermodal and import side, and they're handling it seamlessly on the outside. I haven't heard of any significant issues there. Once it gets on land, on the ocean, that's another story.
Yeah, I mean, intermodal tender rejections, not a huge proxy for capacity like we think of on the truckload sector. Maybe more so if you see service disruptions. There's not really been anything. I mean, it's kind of acted like what you would expect in this environment. I think it's just you've seen so much added capacity on the rails. You look at JB Hunt's container volumes, like they're up substantially. They can absorb it. And the rates are competitive, if not probably priced under where they need to be relative to truckload. And
that's the thing that we've hit on a little bit is like intermodal is potentially doing itself a short-term disservice by keeping the truckload market well supplied. Because when you're talking about a lot of this volume, it's going from Los Angeles to Chicago to Dallas. These are 2,000, 3,000 mile runs. That takes a truck 4 days to run minimum. And then you talk about coming back. It's much easier to ship an empty container back to the West Coast than it is to drive a truck to the West Coast. So they are relieving a ton of capacity.
1,000%. And I think that's what you're seeing. We got one more thing, Zach, and it's your fun with Excel, using the Excel add-in just to kind of show how it can be useful. But I think it highlights where we're at in the market. If we can pull that up, I think
with Excel, maybe it's a new segment we'll talk about. I know a lot of you Excel warriors out there, your spreadsheet warriors out there. I used to be one. I still am to an extent. Of course, we have the Sonar Excel add-in that I've pulled basically the high level market data here. And then I put a little fun column in the middle there called the signal. And it's the bull or a bear signal. For those of you that have watched FreightWaves over the past several years, we always talk about, are you bullish, bearish? Craig obviously likes to play bull and bear a lot of times on the debates. So I put some signals in there that say, hey, what are each market sectors doing? The van sector has 2 bulls in it and 1 bear. on the contracted rate side. Now, those are the Sonar tickers, but the VCRPM is the dry van contract rate. The NTI, the spot rates there, you could almost consolidate that bull signal into one bull signal. So you've got spot rates flashing bull, contract rates flashing a little bit of bear here. But overall, I think this is a market in transition, which is why we have some conflicting signals. Refrigerated side, we got a little bit of a bull signal going on with the outbound tender rejection index for refrigerated. That market continues to be extremely volatile. We've got the maritime side, no real signals here, but we can see rates. If you look at that week over week column, rates are coming down pretty strongly at this point, still significantly higher than they were before the Red Sea stuff kind of triggered. But that is a space that is still hovering around, between that bull and bear signal. And then intermodal, the only sector here, I talked about the dry van, you can consolidate that. 2 bull signals here coming out of intermodal. The one, you don't see any intermodal bull signals coming out of rates, though. Yeah. You see it all in the volume side. So,
yeah, and I think I'll take that. You look at what JB Hunt kind of said, they're really looking at 2025 contract, like that bid cycle's ongoing right now. And like they're in a place where volumes have grown, and it was almost like they were talking about, we're seeing kind of these awards start to be flat to slightly higher. And you look at, you've got it here. I mean, you look at intermodal spot rates right at the bottom. They're basically flat. They're down year over year. They've increased a little over the past week. It's not a huge movement. They're not really moving. Yeah. But they're not going down any further.
Well, if you look at the far right column, annual trend, this is what a lot of these earnings calls are reporting on, is annual trends. We, of course, look at things very quickly, near term here at FreightWaves, but look at all the greens that are flashing tightening or increasing demand. Yeah. That obviously far outweighs the decreasings, and there's no loosening signals on here from an annual perspective. Yeah. A lot of the stuff I look at in near term, week over week, what's happening right now. But from an annual perspective, you can see the transition. Yeah. Every single sector there is showing some sign of, refrigerated maybe a little bit less strong than the dry van. Yeah, but
it's a little more seasonal too, though.
So it is more seasonal.
So it's just kind of, it's really hard to gauge any of that.
But this is a market in transition.
Absolutely.
And that's something that was, of course, reflected in some of the earnings calls. So let's press on, give some, economic color.
Yeah. So the Philadelphia Federal Reserve and the new Federal Reserve Bank of New York, so the New York Fed, they have surveys that come out every month based on manufacturing. They survey manufacturing firms in their respective regions, obviously both kind of in the Northeast, but I use them both as kind of good proxies. I think one of the interesting things that came out of their survey in October is firms over the next 6 months, or over 50% of respondents in both surveys were expecting higher shipment levels over the next 6 months. I don't know. It's hard to really gauge what's causing that, but I think if you're in a freight perspective, to me, that's a sign that, hey, manufacturers are feeling a little more optimistic about moving things next year, which is a good thing for freight demand because, again, the consumer, we've talked about it on here a bunch, the consumer's been the driver of freight demand that we've seen. We've waited for the industrial side of the economy to wake up. To me, this is kind of the signal that, hey, maybe that's coming
we've talked to
sooner rather than later.
Yeah, we talked to Dr. Rogers about this. The industrial sector has been asleep for a large portion of the last couple of years because interest rates are so high. Yeah. So it's continuing to kind of mute a lot of this capital expenditure space. Again, we've got the election coming up and another, Federal Reserve meeting coming up that could change some of this sentiment in the near term, depending on the outcomes of those two things. But for now, I think a lot of people are expecting a much more robust demand side environment in 2025, especially from the industrial side, who has literally been sitting back on the sidelines waiting.
Yeah, in the Philly Fed, they asked special questions at the end, and this one was really around CapEx. How will CapEx be relative to in 2025 relative to 2024? And the results suggest higher levels of CapEx, which to me, they're expecting lower interest rates. They've got to deploy that capital somewhere else where they're not getting a 5% return. Right. On treasury yields, then you go look at treasury yield right now, and it's going up, which is interesting, but that's a trading dynamic more so than a
we don't need to explain the financial market today.
But
maybe another day.
I will say the highlights of that were more around software spending and computer/hardware spending as opposed to other CapEx. But still, at its root, expectations are for higher CapEx spending in 2025.
I think that's a foregone conclusion. Well, let's dive into some of these earnings. I think the first one up here, Ryder, showing kind of a mixed bag, I would say. But again, market in transition. That's kind of the theme of what I would say these earnings calls are really trying to express, is that if we haven't hit the floor, we're somewhat coming off of it. Yeah. And there's signs that we're coming off of it. So Ryder, of course, used vehicle prices, sales prices fell. Their volumes of sales also fell, which means they have more trucks sitting on the lot. Both signs that this is still a very depressed market. Yeah. Because people aren't buying trucks. But that's actually, if you are a transportation service provider, this is a positive sign.
Yeah. You want people to stop buying equipment, right? Like,
this has to happen for a minute. And if we pull up the used truck price chart for 3-year models, you can see we're pretty much crawling along the floor. If anything, we just hit the floor a couple of months ago for the average price of a used 3-year-old truck hitting $50,000.
Yeah.
I mean, and if you look at the COVID value of the same thing, $120,000 to $50,000 in a matter of a couple of years, Tony.
Brutal. I mean, it's brutal for anybody that bought at the top, right? Like, that's what I look at.
And that's only going to accelerate the capacity exit, because the bank loan on that, you can't afford it.
Yeah, exactly. I think that's the takeaway. The other takeaway I have here, I mean, you start looking at some of their other Ryder's an interesting one because of how big that used equipment and leasing aspect is. Yeah. But you look at some of the other ones, like if you were to pull up and look at like their supply chain solution, so think managed transportation, freight brokerage, things like that, like
transportation service,
basically, and you're seeing an increase of 10% in revenue in the year, or in year over year. I mean, that's pretty solid.
Really strong sign. I mean, they actually outperformed some of a lot of these people that are obviously more well-known in the space in terms of transportation service management.
1,000%. I think that's a positive sign moving forward. I won't make too much of the sales. I think it's just it's always one that lags the market, because they'll pick up after the market's already started to change. They'll bottom out after the market's already started to change.
It's actually a good sign for their other business that is actually already picking up.
Yeah, exactly.
So let's move on to the largest truckload for hire carrier in the United States, Knight-Swift, of course, reporting their earnings. My biggest takeaways here from Knight-Swift on the truckload side, this is, again, this is a transitional state for this freight market. We are no longer seeing necessarily like huge changes in the pricing structures here. So if you look at their earnings, if you read Todd Maiden's article, revenue drop, that's not great. 6% revenue drop quarter over quarter, or year over year, Q3 over Q3, not good, but that's explained almost entirely by volume. Yeah. If you look at the volume figure, 5.6% down versus 6.1% down. Okay, they've got a volume issue. That is not news. There's still just too much capacity they're competing with. Their tractor count is down 5% year over year. This is the nation's largest fleet in the for-hire space, and they just dropped their tractor count down 5%. That is massive. But if you look at their revenue per load and everything that kind of measures like pricing, their pricing's flat. Yeah. They're not lowering rates at this point. But they're giving up volume to hold steady on their rates.
Yeah. I sent it to you last night because I saw the quote out of their earnings release. It said third quarter revenue per loaded mile ex fuel surcharge was flat year over year and increased slightly over the second quarter. And my message to you and joke was contract rates are going up. They're going up. And it was a little hyperbolic. I mean, but I think the positive sign is they're not falling anymore. Well, I mean, if you suggest that, if you look at contract rates, if you looked up the quarterly average, they are down year over year. Not I don't think that should be a surprise.
No.
But if you looked at the second quarter and the third quarter, they're up ever so slightly, which to me suggests we're slightly off the bottom.
Our contract rate data suggests that we are turning up. It's like a plane that's been riding along the runway for a minute, and you're starting to see the pilot start to pull back on that lever. I think that's. I don't know that he's going to take off real quickly. This isn't John Wayne Airport out in La Mirada there, but it may be a slow takeoff, but it looks like we are starting to take off here. So the next segment that I want to talk about here, they have, of course, Knight-Swift acquired, some LTL and several LTL companies now at this point. And that, their revenue growth largely attributed to acquisition in the last year or so. They've added a few companies. So revenue growth, I take that with a grain of salt. Shipments per day, grain of salt. There really wasn't anything here that I think we can take a strong takeaway from. This is why a lot of companies buy other companies. Is financial reports are basically irrelevant.
It's a win. I mean, it boosts all your numbers.
The thing I watch for here, and this is actually a pretty positive sign in my book. Their OR dropped to 89.6 from 84.9 a year ago. That's not as bad of a drop as I think I would have maybe expected with an LTL acquisition, because a lot of times you buy these beleaguered companies and the reason that they're beleaguered is because they're not making a lot of money.
Well, I mean, it's so different in their truckload sector where they bought US Express, right? I mean, if you were to pull that one back up, I mean, 70 basis point decline in the truckload OR, but I mean, if you actually read the release, it's like 220 basis point negative hit because of US Express's like they actually improved their existing business by like 210 basis points. So it's like they've done things. When you see these acquisitions, you're spot on. And truckload or LTL, like the LTL probably hurts a little worse in the initial stage as you're trying to get terminals operating the way you want and things like that, versus a truckload market where you're just trying to fit the trucks into the network to some degree. But I mean, you're still operating sub 90, which in this environment where you're starting to see, we'll touch on it more with Old Dominion here in a second.
Let's go ahead and get through the last couple of sectors here. Knight-Swift Logistics, revenue down, loads down, revenue per load up, margin flat. Looks like they're turning down freight to maintain some margin. Not a terrible sign here. I don't know that there's anything really to read into. Intermodal improved in terms of OR, but their revenue per load was down. Their volume was way up. So I would have expected a little bit better, but they're trying to get to profitability.
And I think the side we talked about earlier, right? It's Intermodal's effectively giving up pricing.
They're hurting themselves by adding capacity. By having all this additional capacity, they actually would do themselves a little bit of a service if they said, "Hey, maybe go try to find a truck instead," which is a crazy thing to state, and I know that's not the right business move by any means, but that's sort of what needs to happen. So let's pull up Old Dominion here. Last but not least for the day, LTL, the premier LTL carrier in the United States. I think everybody kind of sees that as true. Tends to be higher priced, but that's because their quality of service is highly regarded. Tonnage down, shipments down, revenue per hundredweight up. Guess what? That metric does not matter because look at the OR. Their OR dropped. Who cares if your revenue per hundredweight went down? I've said this 1,000 times. Revenue per hundredweight by itself may be the most pointless metric we look at. But their volumes are down. I think my read here, the yellow bubble has already exited the market. Like we've now seen this a little bit ingestion of all this freight that kind of boosted Old Dominion, Saia Estes, all these bigger LTL providers, national LTL providers.
You had a quick movement of that volume.
And they had to get out quick. So that gave some pricing pressure. And it also meant there was volume that kind of boosted for a minute. Well, guess what? All of that capacity is now getting ingested, and you're seeing the volume disperse more widely in the LTL sector.
As you go through a true bid cycle.
Exactly. And now we're starting to see things kind of wash out.
Yeah, my takeaway on this one is Old Dominion is not going away from their pricing discipline. They are staying disciplined in pricing, and they would rather take a hit on volume than they would give concessions on pricing. And it's evident when you look at revenue per shipment is up and shipments are down.
Yeah.
I think it just highlights that they're willing to turn away volume that would be priced lower. And I think that's my read on.
And we have some back end LTL data that I've been looking at that shows this exact impact of the LTL bubble, the yellow bubble, as I'm calling it, because all it did, because truckload and LTL actually move relatively well together from a pricing direction standpoint. Yeah. LTL bid cycles are 12 months and much stickier, guaranteed capacity versus truckload's paper rate, as we call it. So those rates don't move as quickly, but the prices that come in, they're coming in at new rates and lower lows every day. And that's been happening since 2022, except for that hiccup last year.
Yeah. So I think the LTL market is an interesting one as we close out the show.
It'll turn when the truckload market turns.
Yeah. Or if the industrial side of the economy wakes up, that helps feed that volume.
And industrial side really influences LTL. So I'm bullish on LTL next year.
Yes. I would agree with that.
All right. Y'all have a great week.